The doors close inside the Federal Reserve Building in Washington, D.C. It's late, far past normal working hours. Inside, a small group of unelected officials sits around a table. There are no cameras, no public statements, no vote from Congress, just data, models, and a decision that will quietly shape the financial fate of hundreds of millions of people. On one side, inflation eroding purchasing power. On the other, unemployment, fragile markets, and the risk of pushing the economy into recession. Raise the federal funds rate, borrowing becomes expensive. Lower it, and money floods the system. That number will ripple into every corner of life. The monetary system is a layered machine built over centuries, designed to balance control and chaos, stability and growth. How did a system designed to stabilize the economy become one of the most powerful and misunderstood forces shaping the modern world? To understand that, go back to the beginning, to a time when money itself was the problem. In the early years, there was no unified system. Different banks issued their own currencies. States had their own rules. Trust was fragile. A dollar printed in one state might not be accepted in another. Trade was slow, credit was unreliable, and crises were frequent. The first attempt at order came in 1791, but to stabilize a decentralized economy, the government needed to centralize power. This tension between control and independence would define the American monetary system for centuries. When the bank's charter expired in 1811, banks expanded rapidly, issuing excessive credit. By 1819, the nation experienced a major financial crisis. To understand why that matters, you have to understand what money actually is. Money is not just currency, it is credit. Imagine the system like a network of pipes. At the center is the central bank. From it flows liquidity into commercial banks. When a bank gives a loan, it doesn't hand out existing money, it creates new money. This is the core mechanism of the system. But this system depends on confidence. If banks lend too aggressively, bubbles form. If they pull back too quickly, the system contracts. In 1907, the financial system teetered on collapse. At the center was not a government institution, but a private banker, J.P. Morgan. His rescue revealed something uncomfortable. The stability of the entire U.S. financial system depended on the actions of one individual. In 1913, the Federal Reserve was created to act as a lender of last resort. But even this carried the same paradox. The ability to influence the entire economy through a few levers makes the system powerful, but it also introduces new vulnerabilities. By the 1920s, credit was expanding and markets were soaring. Beneath the surface, the same old pattern was forming again. The system designed for stability was fueling expansion, and a hidden flaw was growing that would redefine the role of money forever. The very tools used to create stability could also create the conditions for collapse. That is the central paradox of our monetary system. In October 1929, the system finally breaks. The stock market collapses, not in a single moment, but in waves. Prices fall, briefly recover, then fall again. Panic spreads, investors rush to sell, banks begin to fail, credit disappears almost overnight. What begins as a market correction quickly transforms into something far more destructive, a systemic collapse. As asset prices fall, borrowers lose collateral. Loans are called in, businesses shut down, and workers lose jobs. With less income, spending declines. That decline feeds back into business losses, triggering more layoffs and further contraction. This is not just a recession, it is a collapse of money itself. In a credit-based system, when loans disappear, money disappears. The Federal Reserve, still inexperienced, makes a critical mistake. Instead of injecting liquidity, it allows the money supply to contract. Banks fail by the thousands. Depositors lose savings. By the early 1930s, the U.S. economy has shrunk dramatically. The lesson is clear. A system built to stabilize the economy had amplified its collapse. In response, the architecture of the system changes. Deposit insurance is introduced. Regulations tighten. The Federal Reserve evolves from a passive observer to an active manager of economic cycles. Money itself is redefined. Until this point, the U.S. dollar is tied to gold. Every dollar represents a claim on a physical asset. In 1971, that link is broken. The dollar becomes fiat money, backed not by gold, but by trust in the government. Now, the supply of money can be expanded when needed, during recessions or financial shocks. But this flexibility introduces a new paradox. If money can be created without limit, what prevents its value from eroding? The answer lies in control with the Federal Reserve. When the Fed wants to stimulate the economy, it buys government bonds from banks. In return, banks receive newly created money. Banks now have more capacity to lend. Interest rates fall, loans expand, and economic activity rises. This process becomes explicit through quantitative easing. The central bank creates money digitally to purchase financial assets like bonds. The goal is to lower interest rates and encourage risk-taking. But here's the hidden flaw. This money does not flow evenly. Asset prices rise first. Those who own stocks and real estate benefit, while those relying on wages see the effects much later. The tool that prevents collapse can also widen inequality. This is the modern paradox of monetary policy. The pattern repeats in 2008. This time the catalyst is housing. Banks extend massive credit to borrowers through complex financial instruments. When housing prices fall, the structure unravels. Banks face massive losses, and once again the system faces total collapse. But this time, the Fed acts aggressively. Interest rates are cut to near zero. Massive liquidity is injected to prevent failure. The system survives, but stability now depends on belief in policy. Today, the dollar sits at the center of the global economy. 3 variables matter most: interest rates, liquidity, and confidence. When all 3 align, the system grows. When they diverge, stress appears. The monetary system is not just a background mechanism. It is the foundation on which modern finance is built.